This is Nightly Business Report with Tyler Matheson and Sue Herrera.
New record, the S&P 500 and the NASDAQ close at all-time highs again. No wonder more and more investors ask, is this the greatest bull market of all time?
Smartphone addiction. Two big Apple investors want that company to do more to prevent overuse by kids, but is it Apple's responsibility?
And the long haul. As the economy keeps on trucking, so does the trucking industry. Those stories and more tonight on Nightly Business Report for Monday, January 8th.
Good evening, everyone, and welcome. Stocks extend their 2018 gains. It wasn't a rip-roaring rally to start the week, but it was enough to push the S&P 500 and the NASDAQ to new records. Investors remain upbeat about the economy and confident that it will continue to pick up steam. So here are the final numbers. The Dow pulled back a bit, dropping 12 points to 25,283. The NASDAQ gained 20, and the S&P 500 gained 4. With a string of record runs and 2018 getting off to a robust start, some may start to think that this bull market is shaping up to be one of the strongest ever. Mike Santoli picks it up from here.
The bull market, set to reach its 9th anniversary in 2 months, is now the second best ever, which means that investors who expect generous gains from here over the next couple of years are effectively betting that this bull run can become the greatest of all time. In terms of market gains, valuation, and the public's exposure to stocks, only the final years of the 1990s surge sit at higher elevations than the climb that began in March of 2009. This might sound scary for anyone who recalls the speculative frenzy of the late 90s market and the wealth destruction that followed as the tech bubble burst. But the comforting news for now is that while today's bull market ranks number 2, it's still quite a distance from the excesses of the one that closed out the 20th century. The S&P 500 has gained just over 300% from its low set during the great financial crisis in early 2009. That compares to a 580% advance that ran from the 1987 crash to early 2000. And while stocks are rather richly valued today, they're not nearly as expensive as at the 2000 peak. Finally, retail investors had nearly 80% of their financial assets in stocks and were feasting on half-baked initial public offerings 18 years ago. Today, they hold closer to 70% in stocks, and the most popular investments are sober index funds. All this explains why some optimistic strategists are predicting a more energetic phase of the bull market as public excitement for stocks grows and the new corporate tax cut offers a fresh storyline for further gains atop strong global growth and a healthy consumer. It might all sound a bit too good to be true, and it always makes sense to ask what could go wrong when the crowd is fixated on the good news. For as long as stocks keep clicking to new record highs, though, the comparisons with the greatest ever bull market will only get louder. For Nightly Business Report, I'm Mike Santoli.
Well, investors who focused on growth stocks last year were richly rewarded. Large cap growth funds were up nearly 30% in 2017, while large cap value funds rose just under 16%. So will growth continue to dominate this year, or should investors now start to nibble more in value stocks and mutual funds? Joining us now to discuss that, Kevin Caron. He's portfolio manager with Washington Crossing Advisors. Kevin, always good to see you. Let's do a little level setting here. I just love for those who don't know those terms of art to hear from you what the difference is between a growth stock or fund and a value stock or fund. What are the distinctions?
All right. Well, the growth stocks are going to be those companies that trade with higher multiples of earnings or multiples of book value, and value are going to be lower. Now, you might say, well, why not always buy the thing that's cheaper? And the difference is, as you might guess, growth. So in the last year or so, as we've seen growth pick up in the global economy and earnings growth really pick up for the tech sector in particular, we've seen the growth investors be more willing to pay higher multiples to own the growth sectors. And so that's why the growth style has by far outperformed the value sector.
What do you say to those who say that valuations overall, whether you're talking about value or growth, are still pretty richly valued? No pun intended.
Yeah, well, they are, and it's really across not just growth and value, but if you look at the overall stock market, it's trading with a value that is relatively high compared to the underlying economy. Roughly $28 trillion is the value of the U.S. stock market. The economy is $18 trillion, so by that measure, it's fairly rough, and it's it's fairly rich, and also price to earnings is also fairly high overall. So they're both fairly high, and growth in particular is higher.
So what are you doing in the portfolios that you manage that our viewers could then maybe extrapolate and apply in their lives? Are you paring back your growth allocations and looking at more value companies and funds?
Yes, so coming into 2018, we have done exactly that. We had been overweight growth on prospects of a better growth in the economy. We've seen that, but we're getting a little bit concerned about the relative valuation between growth and value. So we've trimmed back our growth allocation from overweight to neutral, and we've lifted our value weighting from underweight to neutral, citing better relative valuations for the value sectors.
How do you feel about the economy overall? Because that's basically what's going to continue to drive stocks.
Yeah, really solid. There's very little in the data that concerns us here. The earnings are growing very nicely. The employment data seems to be fairly good. And the overall outlook for inflation and interest rates is relatively benign. So there's nothing in the immediate data that concerns us. And we would assume the near-term outlook for recession, for example, would be relatively low and encourage us to remain overweight equities overall compared to bonds.
All right, Kevin, thanks very much. You're the last guy there tonight. Go on home. Kevin Caron with Washington Crossing Advisors.
Thank you.
Good to see you.
In Washington, the Treasury Secretary has reportedly asked Congress to lift the federal government's debt ceiling by February 28. That's according to Bloomberg. The Treasury will exhaust all of its borrowing options and run out of cash to pay its bills by late March or early April if Congress does not raise its borrowing authority. The Treasury Secretary, Mr. Mnuchin, has said repeatedly that he would prefer the debt limit raised well before the government faces a potential default.
Dow component Pfizer will halt research into Alzheimer's and Parkinson's treatments. The drug maker says the decision reallocates money to other areas. Pfizer had made big investments into neurodegenerative diseases, but faced some setbacks recently. There is no known cure for either Alzheimer's or Parkinson's. Separately, the biotech company Axovent will no longer develop a dementia drug because that drug failed to meet certain goals in recent studies. Shares of both Pfizer and Axovent fell, with Axovent, a small cap stock, seeing its value more than halved.
That was just one of the very hot topics being discussed at the biggest healthcare event of the year. Meg Terrell spoke to a number of industry CEOs at the J.P. Morgan Healthcare Conference, and that's in San Francisco.
A rainy day of weather kicked off the annual J.P. Morgan Healthcare Conference in San Francisco. It's the year's biggest event for healthcare investing, where more than 450 companies present over 4 days to more than 9,000 attendees. It's always a big conference for deal news, and this year we did get a deal from Celgene. It's spending $1.1 billion to acquire cancer drug maker Impact Biomedicines, gaining a drug for a rare form of bone marrow cancer. We talked with CEO Mark Aulis about that at the conference.
Well, first of all, it's a hematology play, and our DNA at Celgene is hematology. Second, it's a highly unmet medical need. Myelofibrosis is a rare cancer, but at the same time, up until now, there's been only one FDA-approved drug ever for the disease.
Following the deal, though, biotech stocks were under pressure, as some may have hoped for Celgene or others to do bigger deals in the space. Many wondering if the U.S. tax overhaul will spur M&A. We talked with Eli Lilly CEO Dave Ricks about the impact of tax reform.
We're worried about the lopsided nature of foreign competitors who had better tax environments than we did. That's now addressed. I think strategically that's the most important thing that came out of this tax reform. It will allow us also to invest without thinking about the tax rate so much, but rather put plants and labs where it makes the most sense, where the talent is and where the markets we're serving are. So overall, it was, I think, a successful package from a pharmaceutical sector.
Other topics on discussion this week have been drug pricing. It was, of course, during this week last year that President-elect Donald Trump made his comment that the industry is, quote, getting away with murder when it comes to its pricing policies. And as companies were updating on their drug pipelines and other aspects of their businesses, there was another issue on display, that of gender diversity. According to a recent report from Stat News, of the more than 450 companies presenting here at the conference, only 20 have women CEOs presenting. That compares with 22 presenters at the conference named Michael. We talked with one of those women CEOs earlier.
If you look at the senior team within the company, vice president and above, over half of our team members are women. But It's not just about gender. I think it's a broader question of diversity because making experimental medicines and advancing them is tough, and having diversity is a strength and part of what's going to make us successful.
Something for the industry to work on in 2018. For Nightly Business Report, I'm Meg Terrell in San Francisco.
Well, there has also been a big push by Silicon Valley to move into the very large and very lucrative healthcare industry. Deirdre Boza has that angle tonight.
This year, more than 20 million Americans are predicted to be using smartwatches. Many of them will be using them for more than just telling the time. They'll be tracking how many steps taken, how many calories burned, and resting heart rate. But could a smartwatch one day save your life? Apple is trying to find out. The tech giant is teaming up with Stanford Medicine for a first-of-its-kind research study that will use the Apple Watch to detect irregular heart rhythm that could lead to a stroke. And it's not just Apple. Other big tech companies like Alphabet, Amazon, and Facebook are getting involved in efforts to remake the healthcare industry. A few reasons tech is moving into this space. One, it is a $3 trillion industry in the United States. Two, it's ripe for innovation and disruption. And three, these companies know consumers, and they increasingly have the scale, data, and reach to deliver. In recent years, their involvement in the healthcare industry has surged. According to CB Insights, participation in healthcare equity deals by the 10 largest U.S. tech companies has increased tenfold in the last 5 years to nearly $3 billion last year. Some of those deals include Amazon's participation in a financing round for Grail, a cancer detection startup. Apple acquired sleep tracking company Bedit, and Alphabet bought Synosis, a health monitoring startup. Their efforts are much bigger than just those deals, though. Alphabet has been expanding Verily, its unit entirely dedicated to life sciences. Apple has HealthKit, while Amazon is more quietly moving in for the moment, and Facebook is making it easier for pharma companies to advertise. Increasingly, healthcare executives themselves are thinking about disruption and innovation in terms of technology. Biogen CEO says that the biotech industry needs to take the lead in changes, be what he calls the Tesla of the industry, and set new models.
We need to bring this industry closer to the consumer, closer to the patients. We are meant to provide support to the patient who are sick, not to take advantage of those.
Meanwhile, some analysts say the road ahead for tech and healthcare won't be without bumps as they learn to understand regulatory procedures and patient-clinician relationships. For Nightly Business Report, I'm Deirdre Boza, San Francisco.
Still ahead, screen time. Should Apple do more to curb growing smartphone addiction among kids?
Two prominent Apple shareholders have made an unusual request. They're pressuring the company on a social responsibility issue, not a corporate one. The focus is on children and whether the company should do more to fight smartphone addiction in kids. Josh Lipton has the story.
Believe it or not, the average American teenager got his first phone before he was a teen, at roughly 10 years old. And that teenager today currently spends nearly 5 hours a day on it. And that doesn't even include talking and texting. Jana Partners and CalSTRS, two Apple shareholders who own a combined $2 billion of the company's shares, are concerned, citing that data in a letter they sent the iPhone maker over the weekend. The shareholders are worried that the iPhone could hurt children, saying, as one of the most innovative companies in the history of technology, Apple can play a defining role in signaling to the industry that paying special attention to the health and development of the next generation is both good business and the right thing to do. They point to alarming data that children are increasingly distracted by digital devices in the classroom, and that teenagers who spend too much time on such devices are at higher risk of depression and even suicide. One of the researchers cited in the letter says children and their parents would benefit if they weren't overusing the devices.
For Apple in particular, they make their profit when someone buys the device and owns it. It doesn't matter how often they use it. And what the research shows is for teens, the happiest teens are those who have the phones but use them about an hour, maybe 2 hours a day. It's beyond that when the issues start to show up.
The shareholders want Apple to convene a panel of experts to study the issue, partner with experts to conduct further research, and offer parents new tools and options. Apple does already offer parents help. They can take an active role in restricting the apps and features that their children use on these devices. Some might counter that the responsibility isn't ultimately with phone manufacturers, but with their parents, and that it's often the social media apps like Facebook and Snapchat where young people spend their time. But Jana and Calster say that Apple can do more and argue that addressing the issue today will boost the long-term value for all shareholders by creating more choices and options for customers. For Nightly Business Report, I'm Josh Lipton, San Francisco.
As Josh mentioned in his report, today's typical teenager may spend nearly 5 hours a day glued to that smartphone, and that lack of face-to-face time could be detrimental to a young person's well-being. So is it the responsibility of companies to educate parents on the risks associated with their products and services? Here to talk about that is Dan Eaton. He's a business ethics instructor at the Fowler College of Business at San Diego State University. Welcome. Nice to have you here.
Good to be with you.
So what do you think about the basic premise that we put forward? What is the responsibility of a company like an Apple or another smartphone maker to the customer and the customer's parents?
Well, the responsibility of any company is to make sure that consumers are sufficiently well informed of the risks that come from using their products. So when you talk about whether it's a responsibility of the company on the one hand or the end user or the parents on the other, the answer is, well, yes, it's the responsibility of both. And it's really good business. It's good for the bottom line. This is not entirely about corporate social responsibility. It's also about protecting shareholder value, which is why two big shareholders with $2 billion invested in this company want pro-action now.
You know, it's interesting that these shareholders who happen to be Apple shareholders have gone to Apple. It could be Samsung, could be another manufacturer, Google or whomever. What they seem to be calling for is, as you say, a more proactive position on the part of Apple, potentially to come up with wrinkles or products that they put on the phone that make it easier for parents to limit or monitor both the time or the ways, and there are those products out there, but they're just not as, and Apple already does some of it, but they're just not as easy to use as I think these people are calling for.
And it doesn't seem to take anything away from Apple's bottom line to make them easier to use. The bottom line is that there is no defeat device that is going to override the insistence of a teenager, period. The bottom
you can
line
say
is,
that
though,
again. Yeah. There is no defeat device for teenagers.
We both got kids that use them. We know what you're talking about.
But that said, it is sometimes the responsibility of these companies to make it easier for parents to exercise that control. Barbara Booth, our strategic editor, has an excellent piece on CNBC.com about the kinds of things that parents ought to do. And it's with them that the ultimate responsibility rests. But companies can do more, and they should do more, because it is good business. This is not just about saving the world. It's about protecting a vulnerable population, which is children. And it's about giving parents the tools to do their ultimate job better.
Do you think that most parents are even aware of how much time their kids spend on a phone? And would they be more proactive if they realized it? Or how integral that device is to their daily life?
They're probably not aware, but they're going to be more aware now, having watched this segment. And the bottom line is that allowing this kind of a device, which controls the amount of time, will enable them to place those controls regardless of how much they know about their own children's usage. There was a report in the package that you just ran that children are happiest when they only use about an hour or two on these devices. And this technology will enable parents to ensure that their children are as happy as they can be without getting addicted. I mean, the piece that Barbara Booth ran talked about this being referred to as digital heroin. That's scary. And it's better to take steps now to avoid that kind of thing than to let it get out of control with the reputational risks that are ultimately going to jeopardize these two investors' financial stake in Apple.
Dan, thank you so much. Appreciate it. We're all jealous that you're out in San Diego and we're not. Thanks for joining us tonight.
And yet it's raining here, so.
Okay, there
right.
you go. Dan Eaton with San Diego State University.
Well, GoPro may be open to selling itself, and that is where we begin tonight's market focus. Just hours after the wearable camera maker said it was cutting jobs, lowering its fourth quarter sales forecast, Reuters said the company has hired J.P. Morgan to help explore a potential sale. The company, which has been experiencing weaker demand, said it was exiting the drone business, cutting CEO Nick Woodman's salary to $1. Earlier today, Woodman said a potential merger wouldn't be out of the question.
If there are opportunities for us to scale awareness of GoPro globally by being a part of a bigger company, that's something that we would entertain. But of course, we need to run the business as though we're going to be independent, and we're planning accordingly, and we're looking forward to benefiting from the improved sell-through we're seeing on all of our products at their new pricing, and we're looking forward to profitability in the second half of 2018.
GoPro shares plunged nearly 13% to $6.56. The restaurant and gaming chain Dave & Buster's slashed its full-year profit and sales outlook after reporting a drop in same-store receipts during the holiday period. The company said weak foot traffic at the beginning of the quarter never picked up steam like it initially anticipated. Despite the disappointing guidance, Dave & Buster's said its new stores are performing well. Shares cratered, though, 22%. They finished the day at $43.79. On the flip side, same-store sales at Kohl's rose during the holiday season as more shoppers visited Kohl's locations. The retailer expects its offerings will continue to attract shoppers. It is hiking its profit outlook for the year. Shares rose more than 4% to $56.90.
Tenet Healthcare said that it will cut even more jobs than initially planned as the hospital operator tries to keep a tight lid on costs. The company now expects to eliminate 2,000 positions, which it says will save Tenet about $250 million. Shares were off 3% to $14.95. Despite reporting solid holiday sales, the discount retailer Five Below saw its shares pressured after it gave earnings and revenue guidance for the current quarter that trailed analysts' estimates. Shares were down 7% to $66.95. And the footwear maker Crocs is increasing its fourth quarter sales and gross margin outlook. The company also said it expects operating costs to be relatively flat compared to last year. Shares of Crocs finished the day up 8% to $13.23. And after the bell, Urban Outfitters reported a smaller than expected rise in same-store sales during the holiday shopping season. The shares were initially lower in after-hours trading, but finished the regular session down 1.5% to $33.74.
And coming up, why one industry just keeps on trucking.
A failed Atlantic City casino may get a new lease on life. The former Revel Casino was purchased by a Colorado developer for about $200 million. The developer called the acquisition a dream come true. He plans to reopen it this summer around the same time the former Trump Taj Mahal Casino will reopen under the Hard Rock brand. The former Revel will be called the Ocean Resort Casino.
Well, last year was the most expensive on record for natural disasters. Hurricanes Harvey, Irma, Maria, along with the wildfires that ravaged the western part of the country, caused more than $300 billion in total damage. According to the National Oceanic and Atmospheric Administration, the largest cost came from the hurricanes. Prior to last year, 2005 was the most expensive disaster year. That year, of course, Hurricane Katrina caused more than $200 billion in damage.
Takata is expanding the largest automotive recall in U.S. history. The Japanese airbag maker is recalling 3 million more faulty airbag inflators. In total, more than 19 automakers have been affected and more than 42 million vehicles. Those recalls and the criminal conviction against Takata forced that company to file for bankruptcy protection.
Well, have you noticed more and more trucks on the road? Well, the answer is probably yes. When the economy grows, as it has been doing, more goods need to be transported, and that is resulting in a spike in demand for 18-wheelers. Morgan Brennan hits the gas.
As the economy keeps on trucking, so too does trucking. Demand for trucks is skyrocketing, and that means higher rates. Freight exchange service DAT Solutions says the price to hire for the most common kind of truck jumped to $2.11 per mile in December, up more than 25% from the start of 2017 and marking the highest monthly average rate since at least 2010. Analysts say that could go even higher.
It's going to mean higher rates for shippers. The biggest question for shippers is whether or not they can get the capacity. Because if they're not willing to pay up, they're not going to get the capacity. That's just the clear pattern that's being established right now. For consumers, it means higher prices at the shelf. It means higher prices delivered because they've been getting a discount on shipping, and those days are over, at least for the foreseeable future.
More manufacturing activity, a robust holiday season, ongoing rebuild efforts from hurricanes, and new regulations are all playing a part. Last month, a new rule took effect that makes the industry track driver hours electronically. That's helping to take some trucks off the road, and just as volumes are soaring.
The biggest winners are going to be the people that own the assets, the XPOs, the FedExes, the Knights, the Werners, the Celadons, the Covenants. If you own the truck and the trailer, then you are in a great position right now.
The demand is helping fuel a resurgence of vehicle orders, according to ACT Research. In December, fleets reserved the most Class 8 trucks, the kind used on long-haul routes, in a single month in 3 years. That's something that could benefit manufacturers like Navistar, Daimler, and Volvo AB. But it's not just trucking either. Volumes of goods moved by railroad, barge, and plane are all growing. It's good news for the companies moving them, but bad news for retailers and other shippers, since stronger demand also means higher costs. For Nightly Business Report, I'm Morgan Brennan.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Matheson. Have a great evening, everybody, and we will see you back here tomorrow.